Welcome to my video. I'll trust you'll find it helpful and informative. Please remember to like and subscribe. Thank you.
So what is a capital budgeting technique? It means before we going to invest money in anything, we need to know, is this investment worth our while? Because really, if you're going to buy a fantastic, you're a doctor, okay? And you're going to buy a fantastic diagnostics machine. It's going to cost you 5 million, okay? You need to know, is that machine going to pay you back over the period? Now, choosing a doctor is a bad example because the answer is just simply yes. If it doesn't, you say, I'm going to charge 300 times medical aid. Okay, percent or 300% of medical aid and you sort it. Okay. But in a business, it could happen. Maybe that machine will give you a return on investment of 7%. Really, if you can put the money in the bank and get 8, why would you even be in business? Okay, so especially when you're talking about equipment, if you're going to invest in equipment, you must be able to get out of that equipment what you wanted from it to start with. So that's the idea. So I said any capital investment must make more money for the business than it would have got if the money was simply put in an investment account. Because really, if you put an investment account, that's the easiest thing to do. Okay. i.e., the required rate of return will always be more than the current investment rate. Now, that required rate of return is a subjective thing, not objective. So if you say, you know what, I want my money to grow at 10%, and I know inflation is 5%, then you can say, you know what, for me, the rate of return must be 15% in this business. And then you go and you do your calculations on 15% and you say, oh, no, this is working, wonderful. Or, you know what, this is not working for me. So rather than not invest in the business, to keep the money in the bank. You do understand that at this moment in time, part of the biggest problem that we have in the South African economy is that big business are sitting on their money. So it's not like there's not money, okay? You almost cursed. There's a lot of money. Shouldn't do that when I know I'm recording myself. There's a lot of money, okay? But the money is in bank accounts. That's why the financial sector are still doing okay. Okay, so money in the bank is actually in an economy completely useless. Doesn't help anybody at all. Money must get into the economic cycle, and only then is it actually making more money or it's adding value. Have you ever looked at a banknote? It's not I don't really carry those around anymore because I always carry a card. But I don't know. Banknote? A banknote, yeah. I don't know if you've. So here's a 50 Rand. Now you do realize this is a piece of paper. No, you can see it, Shaquille, I know. And this piece of paper has got a signature on it. Who signed it? Let me just see. Okay, Ganyahu. He signed it. Wonderful. The governor of the Reserve Bank. And this piece of paper in itself is worth nothing. It's nothing. But I won't tear it because I can still exchange it. What gives this note value is the fact that the governor of the Reserve Bank is giving me a guarantee. In fact, he's promising. That's why we call it a promissory note. He's promising me that in the South African economy, this piece of paper can still be traded for things worth 50 Rand. That's all. Okay. So when I put it in my wallet, it's not contributing to the economy at all. But if I go and buy ice cream afterwards, then it's contributing to the economy. Okay. So there's a reason. It's not necessarily a good one, but there's a reason why the government is proposing something like a basic income grant. Okay, because now you're saying, where's the money going to come from? There's no real money, and now you want to give people a basic income grant. They need to put money into the system so that there can be a flow. And as long as companies are sitting on their money, the money is not going into the system. So it's really, look, because government didn't do over the years what they've promised. They're now kind of between a rock and a hard place. You need money in the economy. It's not there. Business is sitting on it. For some reason, they never think about a windfall tax on the state-owned companies that actually make money. Okay. So please, when you read the news, you do understand that it's not quite as bad as the newspapers and online media makes it out, because obviously they're trying to sell newspapers and it's okay, doesn't sell a lot of things. Okay, so you need to say no, it's terrible. We are going to experience an economic crash tomorrow. Then people buy your newspaper or the actually buy the online subscription that you're selling it. So it's not. So our economy is really not doing well. But it's not as bad as the newspapers or the online platforms make it seem. Okay, and there's a simple reason for that. South Africa is a resource-based country. So in bad times, the miners just don't mine, and in good times they start mining again. Or now it's bad times, but the mines are still mining, because China got out of COVID before we did, and so there's an ask for our products. So so we are not a labor-intensive country like some other countries are, which is a pity, because that's why we have with terrible joblessness. But we're a resource-intensive country, and so I mean the resources are in the ground. It's not like the gold is going to get up and pack up and go by itself. Whenever we're ready to mine again for any commodity, we just do that, and we sell that on the international market, and that is why while the economy's been decimated and what we're looking at 50% unemployment, government actually made the tax target. It's because of taxes on the mines. And I'm not an economist. Okay, not at all. It's way more complicated than I try to explain now. But the bottom line is, if we are going to invest in any machinery or equipment, we actually want to make money from it. People do not invest in machinery because they want to make the world a better place. They do it because they actually want money. It's a matter of economics. And when we discuss it in this subject, we pretend that we are in a completely free market society. So in the textbook, this part of the textbook, we are looking at absolute free market economy. The government is not going to come in and take the machine at some point, so don't worry about it. Okay. So now we have these 3 techniques that we can use to tell if indeed we are going to make the money that we want. So the one is the net present value technique. And it answers the following question. It says, how much more will future returns be worth than the amount invested today? So we're looking at the time value of money, and it's really a better way. Let's just say it's a better technique. It's more accurate than the next one. The next one is the payback period technique. And it answers the question, how long will it take before we recover the initial investment? It ignores the time value of money completely. But it's sometimes a better one to use if your investment area or your investment climate is very risky. Because in a risky environment, you just want to make your money back as quickly as possible. And that's why you do it. Okay. And then we have the internal rate of return. Now, let me just say, there was no way for me to change it, because this is the way the ICB is going to ask you. They actually give you, this is a question, an exam question, it's always there. Okay, that little table. The internal rate of return is not really a capital budgeting technique in itself. It is the next step of net present value. So net present value only says, is it going to work or not? Internal rate of return says, what must that NPV be exactly? So that is what it does. What rate are we actually achieving on the capital investment that we made? That's the question. Okay. Now let's have a look here at the net present value technique. Okay. It says the following. Here's a manufacturer, and he considers buying a machine for 253,000. That's the cost of the machine. 15% VAT is included. And he expects the following capital inflows exclusive of VAT. Expectation, so this is his budget. He says, I expect that in year one, I'm going to get in 60,000 Rand from this machine. In year two, 70,000. In year three, 80,000. That's when the machine reaches its optimum capacity, and then it just goes a bit back because this machine really has a 5-year lifespan. 70,000 in year five, 60,000, 70,000 in year four, 60,000 in year five. So basically, he's expecting a little curve like that. Okay. He also expects that he will be able to sell the machine that he's buying now after 5 years for 30,000. Basically for parts. Okay. And he says that the cost of capital, which is exactly the same as his required rate of return, is 15%. So the cost of capital is the required rate of return plus the interest rate. Okay. That is the cost of capital. That is what he wants. Okay, because he wants to beat interest and he still wants to make a decent profit. Okay, now in the first row there, we put the number in brackets to indicate that it's negative. Obviously, initially it's an outflow of money. So if you didn't want to use brackets, you could have used a minus. I don't care whether you use a minus or whether you use brackets. Okay. And as I say that, I am actually trembling in my shoes. And I'll tell you why. This silly thing that's come up with the ICB now, where they expect you when you do calculations just to complete the field. And you might say I put a minus and then they were looking for brackets, or put black brackets and they were looking for the minus, and then nobody thought of giving two options. Don't know that's the case. I'm just saying it should not matter whether you use brackets or whether you put a minus. Okay, so that's your cash outflow. It is now. Okay, so the present value is just the amount. It's nothing else. Okay. So initially I am spending 220,000. Then I expect an inflow of 60,000 in year two. Or in year one, end of year one. I'm expecting an income of 60,000. But that 60,000, because of interest and because of inflation, okay, is not going to be worth 60,000 Rand. It's going to be less. Okay. If you don't know how that works, then please do the following. Look at the price of bread today. Then take the money for that price of bread and put it in a little envelope. Né? And then put a date on it, a year from now. And then a year from now, you take out that little envelope and you go to Pick and Pay and you say, I want the bread, and you offer to pay that price. They're going to say to you, no, that's not the price. It's increased. It's now more expensive. So money has a time value. It's always worth less in the future than what it is worth now. And then you do this calculation. In year one, you divide that 60,000 with 1.15. Okay, why 1.15? Well, 1 plus whatever your cash cost of capital is. If your cost of capital was 20%, it would be 1.2. If your cost of capital was 10%, it would be 1.1. But now your cost of capital is 15%, and so it is 1.15. Also, please notice here that in this first row here with the actual, it was 220, and 220 is simply the VAT, the amount exclusive of VAT. So also there I went and I said 253 divided by 1.15. In this one, it is just per chance that the cost of capital and the VAT is the same thing. It's a box, okay? Please don't think it's a rule. Just by chance here. Okay. Then in year two, I have a capital inflow of 70,000. Now I divide it with 1.15 to the power 2. Not just 2 anymore, 1.15, but to the power 2. Why? Because it's got this compounding effect. Okay. So when I do that calculation, I get to 52,930. At the end of year 3, I expect 80,000 to come in. Now I divide it with 1.15 to the power 3. If this confuses you, think year 1 to the power 1, because that's just the thing. Year 2 to the power 2, year 3 to the power 3, and so forth. Okay, it's not like you can really make a mistake. In year 4, 70,000 divided by 1.15 to the power 4, and in year 5, 90,000 divided by 1.15 to the power 5. Please go and play on your calculators, like I always say, and make sure that you get the correct answers. One of the second years had a very fancy calculator in here last week that my conclusion is that calculator is completely useless. And unless you have a master's degree in knowing how to operate it, because it gives you a return before you've even included the power.
Yeah, I know that calculator.
Yeah, and then you're gone. Okay. Now the way around it is just to use brackets. But your normal inline calculator, the Seiko or the Casio or the good old Sharp, the one that I told Cara to buy is the best calculator for the price. Go and show them.
Sure.
She was going to.
The dinosaur.
No, it's a good calculator because
Stop calling me old.
and the reason is that the Sharp costs 300 rand and the same Casio is going to cost you 500-600 rand.
Okay.
And therefore the Sharp. But now please be careful based on my experience of the no-name brands. The no-name brands will do exactly the same for you that these good, better calculators do, but they are flimsy. They break. Or what happened with the one that I bought is the numbers actually disappeared off the buttons. Okay. That's now the problem with that is, according to the ICB, you cannot use your cell phone in an exam. Okay. That's actually very important because there's nothing wrong with a scientific calculator on your cell phone. That is absolutely perfect. But you're not allowed to use that calculator in the exam. And guys, I do not keep extra calculators. I used to keep 2 extra calculators. Then one day they walked out the door. I must believe that they walked out the door, else they were lifted by somebody. Okay. And then I'll have to look at you with suspicion. So I'll rather choose to. So I'll rather think that it actually got feet and walked out the door. Okay. So now what you do, please now guys, at the end of year 5, just pay attention here, at the end of year 5, it is not just the 60,000 that comes in. You must also add the 30,000 that you expect to get for it when you sell it for parts. That's why the amount there is 90,000. You divide that by 1.15 and you get 44,745. Now you simply add all the amounts, remembering that the first one was negative. Now here's the bottom line. If your answer is positive, it means that the rate that you are getting is more than the 15% that you hoped for. And if it is more, then you say, it's okay. I can consider this project. If it is negative, you stop right there and then. you don't even consider going on with the project because it's not beating your rate of return. Okay. Now, it could be that you see it's negative and you say, you know what, maybe my expectations was a little high. Maybe I should drop my expectations, and then you can try and calculate it for a lower rate. Okay. But in this particular case, it stops there and it is positive, so we can consider it. Thank you for watching this video to the end. If you found it valuable, please subscribe and like. Thank you.